Good afternoon, everyone. Today we're going to talk a little bit about cash flow. So far we have talked about the financial statements, the income statement, the balance sheet, the statement of retained earnings. But there's one more very important statement, which is the statement of cash flows. Some people consider this to be the most important statement because if you don't understand where your cash is coming from and where your cash is going, it can greatly affect your business. And if the cash flow stops, then business comes to a halt really quickly. So the statement of cash flows reports on a business's cash receipts and the cash payments for a specific period. The statement reports on the cash flows of the business. It reports why the cash increased or decreased during the period. And it covers a period of time. It's not ongoing like the balance sheet. It's a specific period of time. And it's dated the same as the income statement. The purpose of the statement of cash flows is to explain why net income, as it is reported on the income statement, does not equal the change in the cash balance. Remember that the income statement is prepared on an accrual basis. What the statement of cash flows does is basically takes that net income statement and changes it to a cash basis balance so that you can see how cash was affected. Okay, so the income statement is accrual basis, but the statement of cash flows is based on cash basis so that we can compare the two and see what's really happening. So it helps us to predict future cash flows. It helps us to evaluate management. Are they doing their job properly? Are they achieving the results that you want to see? And very importantly, it predicts the ability to pay debts and dividends. So there's three basic types of cash flows. We have operating cash flows, investing cash flows, and financing cash flows. And so every transaction, all of the transactions that you've been studying, they could be broken down into operating, investing, or financing activities. And it's very, very important that you understand how to distinguish between the three classifications. So let's talk about the first one. That's operating activities. And this is the first section on the statement of cash flows. And this section reports on activities that create revenue or expense in the business itself. Okay? So it's the operations of the business. What are we in business to do? We sell widgets. Okay, so any revenue that we get from widgets is going to be reported in the operating section. We incur expenses in order to be able to create our widgets, right? We have to pay our employees. That's part of our operations. It's part of our day-to-day operations to pay our employees to make the widgets, right? So those type of expenses, those things that are necessary to keep the business operating on a day-to-day basis, those items would be considered operating activities. And this is often the most important category. And one of the reasons for that, and I like to talk about this because you should learn to read a company's cash flow statements. If you are interested in investing in a company, then I would encourage you to read all of their financial statements, but in particular, pay attention to the cash flow statement because you want to know, where is this company getting their money from? If their money is coming from their day-to-day operations, that's a great sign. That's what we want to see. We want to see that the company is getting money from selling their widgets because that's what they're in business to do. Okay? Now, if you look at a cash flow statement, let's say you look at the past 3 years for a company and you're seeing a steady decline in the operating activities, the cash flow of the operating activities, you're seeing that less and less money is coming from the operating activities, that's an ominous sign. Okay, you might not want to invest in that company unless they have some new widget that people are going to want to buy. Okay, so definitely want to see most of our money consistently, most of our cash consistently coming from the operating activities. Okay, now this does not mean that sometimes you will not see that, because sometimes in the beginning, right, companies are just getting off their feet. They may not be getting all of their cash from their operating activities. Okay, if it's a brand new company, the word is just getting out. They may not be making as many sales as they will in the future. Okay, so it doesn't always mean that it's an ominous sign, but we definitely want to see strong operating cash flow. The next section is the investing activities. And investing activities, this is usually the second category that's listed on the statement of cash flows. And it reports cash receipts and cash payments that increase or decrease long-term assets. So if you purchase a building for your business, that's a long-term asset, that building. Or say you purchase equipment, new equipment to make your widgets. Those are long-term assets. You expect those that equipment, you expect it to help you produce revenue for a long, long time. And you have invested in that piece of equipment. Okay? Sometimes students hear investing activities and they think about investing in companies, and that does happen, but what we are really thinking about here is things like investing in buildings, investing in equipment for the most part. Okay, companies do invest in other companies, and that would be considered investing as well. But for these purposes, focus on things like assets, okay? Assets that are going to help the company produce revenue or make revenue, okay? So things like building, equipment, factories, land, anything like that. All right. Then the third and final. Oh, and one more thing before I get off this slide, because I start talking and then I lose my place. So this section reports cash receipts and cash payments that increase or decrease long-term assets. So it's not just the purchase of an asset. It can also be the sale of an asset. So it includes cash inflow from selling the long-term asset. So purchasing or selling the long-term asset. Now, sometimes students will get confused and try to put that in the operating activity because they brought in a little cash because they sold some equipment. But remember, the business is in business to make and sell widgets. They're not in the business of making and selling the equipment that they use to make the widgets, okay? They're not in the business of buying buildings or buying equipment, but they need to invest in a building and an equipment in order to make their widgets, okay? So you have to separate that in your mind, that when we buy equipment, we buy buildings, it is for the purpose of helping us do what we do as a business, okay? But it is an investment in the equipment. It's not a day-to-day activity, okay? So when you're trying to decide, ask yourself, is this a day-to-day activity? And if they don't sell equipment on a day-to-day basis, then no, it's not a day-to-day activity. It's an unusual thing, and they may be selling their equipment because they want to buy something new, okay? That happens a lot, all right? So, we may see some money going into investing activities. We may see money coming out of investing activities. Just depends on where we are. But one thing you do want to look out for, if a business is selling off all of their equipment and not replacing it with newer equipment, that could be a bad sign too. Maybe they're selling their equipment because they're not getting enough cash flows from their operations and they have to sell their equipment in order to keep the business going. So that's another thing you would want to look for in a cash flow statement. Because we're really evaluating what's happening and it's telling us a story about the business. The final section is the financing activities. This is the last category on the statement of cash flows. And this includes inflows and outflows involved in long-term liabilities and equity. Okay, so notes payable, where if we finance a piece of equipment with a note payable, that is a financing activity. If we take out a loan to purchase some equipment, that is a financing activity. We are financing that equipment with a loan. Okay, that's how I want you to think about it. It also includes activities like issuing stock, paying dividends, and buying and selling treasury stock. So when we first start a business and we issue stock and we receive cash for that, we are financing that business by issuing the stock. Okay, so just remember that. You have to think in terms of operating. Is it a day-to-day activity? Investing, am I purchasing or selling something, an asset that is helping me work in my business, but it's not really what I do on a day-to-day basis. It's just something necessary in order for me to do what I do on a day-to-day basis. Or is it a financing activity? Am I issuing stock? Am I paying a dividend? Did I take out a loan in order to buy a piece of equipment? How am I financing this business? Okay, so these are some of the questions that you would ask yourself when you are looking at the transactions and deciding, is this transaction an operating transaction, an investing transaction, or a financing transaction? All right, so that's everything I have today on cash flows. I will see you in the discussion. Good luck, everyone.